Hey, this is Skyler with Regan. We're going to give a quick update here on the shape of the curve and where we think offers the most value. And we're going to take a step back in time to when the Fed just cut interest rates about 10 weeks ago by 50 basis points and what the market would have hoped would have happened and what actually happened between then and now. So if we look at the curve today, and this is live data coming in from Bloomberg, we have each node of the curve here, 6 month down to 30-year. We have where the market thinks interest rates are going. Okay. We take the average of those two over the next year. So we're just talking about a 1 year time frame. We think folks look at their statements, look at their performance at least yearly. So let's take the average of today and a year from now, and that's going to be our carry number. There's two inputs to bond performance, just looking at treasuries. A, what is your carry, your yield? B, where are yields going? So if you take your carry and then you also incorporate where the market anticipates yields are going. So if we look at the 10-year here, the current yield's 4.19. The future is 4.24. You multiply that delta times your duration, you have a slight loss, a slight mark-to-market loss of about 43 basis points. Very simple bond math, very simple math. We add those two up, and it gets us to our expected total return over the next year. Okay, and you can see here, if you go out the curve, if you take on more risk, you're actually getting less expected total return over the next year. So let's take a step back. If we look at September 17th, this was the day before the Fed cut interest rates by 50 basis points. And this is where yields stood back then. And let me expand this a little bit. And this is maybe where the market hoped yields would go. We had plenty of customers that we were speaking with thinking that they should go out and buy duration because rates were going to come down. Okay. And we were telling them, hey, yeah, you want to own the part of the curve that's actually going to decrease in yield and increase in price, which is the front end of the curve. You want to own bills 1 year paper at that point. Okay. So the day before the Fed cut, you could earn 4% on a 1 year bond. Maybe you were hoping the Fed was going to cut 10 times over the next year. In short-term rates, i.e. 6 month or 1 year rates, were going to drop to 2 to 2.25. If the curve was slightly steep, go out to 10-year, 30-year paper, maybe you get 3, 3.25. Those were very hopeful yields. Okay. So what would have been the gain if that would have happened over the next year from September 17th out 12 months? Well, maybe you would have went out and bought 5-year paper instead of owning bills. And if that would have happened, if your 5-year would have went from 344 to 275, well, you would have made a total return of about 6.18%. If you would have stayed in 1 year bonds, however, you would have still earned 482. So what additional yield would you have gained by taking on 4.5 times as much interest rate risk? You would have gained an extra 1.36%. Okay. What actually happened? So same yields that we're using as a starting point, and then we take today's yields. Okay. So you went out and you bought that 5-year bond. Today, that 5-year bond's at 4.09. You've lost 2.28%. Okay. So whereas you would have made an additional 136 if everything right happened, you've actually lost 267. And I don't want to say everything wrong's happened. Okay. Yields have only gone up roughly 60 basis points. Okay. So you're looking at a delta here of a good 4%. Okay. And the magnification of this being roughly 2x what this was goes to show that back then there was a lot more downside to taking that duration risk than there was upside. So it begs a question of, well, when do you go out and take duration? So we created this very simple chart here. And let's just say, expand this a little. The curve is flat. And you can earn 455, which is effectively where money markets are today, across the entire curve. Okay. If you're going out and you're buying that 5 or 6 or 7 year bond, well, you're taking on more risk to get the exact same reward. Your risk reward is actually decreasing. So we think it makes sense to wait. Wait until you get a much steeper curve. And I think the curve in this day and age that you should be thinking about is where index funds are trading 5 or 6 year duration in terms of yield versus what you can get on cash or money market accounts. So if you're getting 455 on a money market account and maybe 505 on a 5 year bond, an extra 50 basis points, okay, well, at least you're getting higher expected future returns or positive returns by taking on more interest rate risk. So we think it's somewhere between 100 and maybe 300 basis points of steepness where it makes sense as a fiduciary, as an investor, to go out and take on more interest rate risk. So we think about things really simply. Wait until the curve steepens out to at least 100 basis points to think about going out any further than, let's say, a 2 year duration. Thank you.